Hey guys, what is going on? Welcome back to my Robinhood portfolio. What I thought I would do now is talk about how I pick a quality dividend paying company. This has come up quite a few times in the comment threads. That is, why have I chosen the stocks that I have chosen for my portfolio? Why do I pick blue chip stocks that have only dividends that are 3 to 5%? Why not pick dividend paying companies that have 10 or 15% dividends? So I thought I'd kind of go through the criteria that I use to first evaluate a company. A number of these criteria have to do with how financially stable the company is, and then a number of the criteria have to do with the dividend itself, how reliable, how sustainable is that dividend over the long term. One thing I don't like about Robinhood that I'll just bring up right now is that in the statistics part of the application, unfortunately, a lot of these metrics are not recorded. I take a look at my E-Trade account that has these different metrics recorded, and these metrics are recorded for all companies. Performance measures, key ratios, financials, valuation. You can take a look online as well to find these. Like I said, I find these in my E-Trade account, but if you go to morningstar.com, for example, that's another great website that will have all these metrics for you as well. So the first couple metrics here are looking at the financial stability of the company itself. So the first criteria is the current ratio, and a lot of these things are pretty esoteric and complicated, but again, you can just look these numbers up to kind of get a sense of how stable a company is with regards to its financials. So a current ratio is basically a ratio between the company's liquid assets, cash on hand, versus its redeemable securities. So basically, how much free cash flow does a company have, with the idea that more free cash flow will more likely have, or more likely be able to have a company that pays a dividend. So the company will be able to pay a dividend if it has good cash flow, is the idea. Typically you want the ratio above 1.5. For AT&T here, it's 0.92, so it's a lot less than your typical dividend paying company. Another ratio we like to take a look at is the debt to equity ratio. So really, how much excess debt does the company have? How much burden of paying off debt does the company have? With the idea that the higher ratio is going to have more burden and the less likelihood of paying out a debt. For AT&T, I was kind of surprised about this. The debt to equity ratio is 92, so 0.92 or 92%, which is well above the 50% threshold that we would typically like to see in a stock. The other thing we can take a look at is the dividend payout ratio. So how much of the company's earnings does the company pay out to the investor in the form of a dividend? And again, we like this to be fairly low. Less than 60% is typically what is considered a good dividend payout ratio. For AT&T, again, it's 91%. So it's a lot higher. It's paying out 91% of all its profits as a dividend. So you can see that's a very, very high dividend payout ratio. Then there's a few other criteria. One of these is actually on the application here itself, and these have to do with the dividend itself. Dividend greater than 3%, but you don't really want it greater than 6% because that is an undue burden on the company to get that dividend out to investors every quarter or every month that it's paid out. So at some point it might stop paying out that dividend. And then you also want a good dividend growth stock, so about 10% increase per year in the dividend. And then you want a company that's paid a dividend or increased its dividends for 20 straight consecutive years, or at least 40 straight quarters is what's typically considered a good company. So AT&T qualifies for all of those three. It has a dividend greater than 3%. It's had greater than 10% dividend growth over the last 20 years, so it qualifies. Again, it's a little bit weak on the financials, but some of these stocks, especially utilities, telecoms, and also pharmaceutical companies, will have a little bit higher acceptable ratios for these. So even though the debt to equity is 92% and the dividend payout ratio is 91%, this is still a quality dividend stock. But if it wasn't in, like I said, a utility, telecom, or pharmaceutical, those would be raising some red flags about the long-term potential of providing a dividend. Then if we go to Pfizer, this will be another company I kind of want to compare. And again, I realize that both of these are in the special caveat of utilities, pharmaceutical companies, and telecoms, but Pfizer's another great company I think kind of demonstrates the usefulness of these criteria. So if we get over to, I think I passed it here. So if we go over to Pfizer here, again, a lot of these stats, metrics are not on Robinhood, but current ratio is 1.25, and it's currently between 2 and 2.5. So that's well above the 1.5 that we typically like to see in a dividend-paying company. So that definitely satisfies the current ratio. The debt to equity is 53, so right at the 50% cutoff there, so 53%. So it also qualifies for that. The dividend payout ratio, however, is 102%. So it's actually paying out more a dividend than it actually is earning. And I think that has a lot to do with some recent downturns in some of its products coming off patent. Again, a little bit more complicated for this discussion, but typically it's always had a dividend payout ratio about 70% or so. So right around the ratio that we like to see in a dividend-paying company. So per all those three criteria, the company health is very good. And then it has, as you can see here, a dividend of 3.695. So the dividend is greater than 3%. It's also had a greater than 10% increase per year over a 20-year time span. So it satisfies all the dividend criteria as well. So the dividend is good, the company is good. This would be a great dividend-paying company. So yeah, those are the criteria that I use. There's a lot of other criteria I use as well, but those are some of the criteria that you can take a look at companies, especially companies that may not be blue chip companies or well-known companies like Pfizer and AT&T. Take a look at the current ratio, the debt to equity, the dividend payout ratio, and then take a look at the dividend itself. Is it a good quality dividend? 3% to 5% is typically what I take a look for. Does it have good dividend growth, greater than 10% per year? And has it sustained that growth over a long-term period, 10 years or 40 consecutive quarters? So I hope that, guys, helps you out. Helps you guys out in selecting dividends. That's why I've picked the dividend stocks that I've picked. By those criteria. And if you take a look at my stocks, most of my stocks have all of those criteria. Again, some of the caveats here: utilities, telecoms, pharmaceutical companies will be a little bit higher with regards to the dividend payout ratio and debt to equity. It can also be kind of a concern with the telecom companies, but for the most part, these are great criteria that you can use to evaluate any dividend-paying stock and really take a look at the financial health of the company as well as the health of the dividend itself. So yeah, just wanted to talk about how I choose stocks. I hope that helped you out a bit. There's a lot of other criteria out there. There's a whole section on dividend evaluation that I really won't go into. A lot of it's esoteric. A lot of it gets into the minutia of the financial health of a company. But these are some of the larger and key metrics that one should take a look at when taking a look at a dividend-paying stock. So yeah, don't want to make the video too long, so I'll kind of end the video with that. As always, if you enjoy my videos, feel free to like, share, and subscribe. The whole point of these videos is to take a look at certain aspects of the investment world and share it with you guys. And most of my videos are based off your ideas. So if you guys have any big questions out there, don't quite understand something, I'm always looking for new topics to learn about as well. So let me know in the comment threads if you have any questions or ideas. And yeah, and kind of with that, I'll end the video, and we'll see you guys next time.